Qullamaggie breakout setups is what you're going to be learning about in this video, specifically episodic pivots and flag breakouts. Bear with me during this introduction because this video is going to be ridiculously in-depth. So I want to outline exactly what it is you're going to be learning. I've split it into three main parts. Part one is going to be focused on episodic pivots and using opening range highs entry techniques. We're going to be looking at those classic CanSlim stocks coming out of multi-month basis on the back of a very positive earnings report. We're also going to be looking at more speculative EPs that could be on the back of news. It could be a new government contract. It could be a collaboration with a much bigger company. It could be an FDA approval for a new drug, so on and so forth. Part two is going to be looking at flag breakouts. There I'm going to teach you how to use buy stop limit orders with the stop loss attached. This is primarily going to look at high tight flags, and I really want to go in depth here to explain to you why a high tight flag and specific things that happen in a high tight flag make it an optimal setup, thinking about it from a supply and demand perspective, but also a risk to reward perspective as well. Then part three is where I'm going to be teaching you about pyramiding and also risk mitigation to free roll trades. There's going to be some maths involved in that section. I'll see if my brain is still going by the end of this video. As we progress throughout the video, you're going to see some market Smith charts, certainly when we're looking at company fundamentals. They are today's video sponsor. There is a discounted trial available in the comments below. And before we get into this video, I would ask you to do two things for me to really help grow this channel. I would love to get this channel to 50,000 subscribers. That would be brilliant. The way I'm going to do that is if you can like the video and please subscribe to the channel if you have not already done so. The YouTube algorithms love it when you do that. With all of that being said, here we go. So by the end of this video, if I were to pull up a chart like this, I just want your eyes to be like laser focused into specifically where the setups are, where the best setups are. So where is the opening range highs breakout? Do you see it? This is the 5-minute chart, intraday chart, 5-minute chart for MBOT. Do you see where it is? Do you also see the two base breakouts and the optimal places to be entering, both thinking about the efficiency of the gain, so compounding capital, but also thinking about optimal risk versus reward? Here you go. There they are. There's the opening range highs. Don't worry if you're not understanding any of this. By the end of this video, that's the point of it. And then you've got two base breakouts. Note the tightness, note how the volume dries up before the base breakouts. As Qullamaggie saying here in a quote, it's the same patterns repeating. It's the same things happening time and time again. One more intraday chart. This is PLTR on the 3-minute chart. Now this here, you could look at it as a flag. You could also look at it, those of you who studied Navini's work will be familiar with a VCP, a volatility contraction pattern. So you get these across all time frames. Some of the patterns you're going to be, all of the patterns you're going to be learning in this video. It's absolutely timeless. It's just supply and demand. So here with PLTR, 1 contraction, 2 contraction, 3 contraction. Do you also see the tight little Davis box forming over here as well? So before we get into it, we're going to be looking at EPs, but it's really important that you understand risk versus reward and what is optimal in terms of risk versus reward, because certainly when you're looking at the EPs, and if you're looking at the more volatile stocks, so much more kind of the micro caps and the smaller cap stocks that are potentially gapping up on significant news, such as it may be a collaboration with a much bigger company, it may be an FDA approval. If it's a biotech stock, it could be a new government contract, something like that. What you may find is the initial risk, if you're going opening range highs and stop loss underneath the low of the day, is like 15, 20, 25% because the stock is so volatile. So it's important. I'm not going to kind of teach grandma how to suck eggs. You can pause the video, you can look at this, but it's important to think about optimal risk versus reward, and you can see that I've labeled it the Goldilocks zone. So it's important to understand where are you targeting your average loss to be coming in and thinking about it relative to where your average gain is, because losses work geometrically against you. So if your average loss is coming in the teens area, it's going to be ridiculously hard, and your equity curve is probably going to be like this and probably heading south actually. So keep that in mind as we go, but I will be touching on risk management a lot in this video. That graph there was covered extensively in another video I've done, which we'll put in the comment section below, where we really spoke about risk versus reward. So let me stop rambling and let's actually start looking at some charts, right? So what on earth is an EP? Now the first ones that I'm going to show you, these are EPs in much more the classic CanSlim type stocks. stocks. What is a CAN-SLIM type stock? I'm sure many of you will be familiar with William O'Neill's book, How to Make Money in Stocks. It is basically companies that have high earnings, high sales, high ROE, institutional ownership. They are selling a global product, like it's just firing on all cylinders a company could fire on from a fundamental perspective. Now, an EP in these stocks, you can often see that a stock has been basing for some period. So with Celsius here, which has a global product, huge earnings, huge sales going to come through, as you can see on the next slide. But you see the size of the base here. Now it's this bar here that we're looking at. So there's actually a gap up on the back of the earnings, huge volume coming through, 52-week highs on the relative strength line. Search my name on TradingView, you'll find it. It gaps up and then it pushes up thereafter. So this is what you're looking for. Don't worry, lots of reps and sets. You're not going to get it on the first one, but big bases, big consolidations, and then the company on the back of a positive reaction to the earnings. How do you know it's positive? Because it's gapping up in price. You can see some basic rules here. Gap up greater than 10%, big volume early in the session and all the pre-market, huge earnings, revenue growth estimates, news coming out, breaking out of a multi-month base. So if we take a look at Celsius, on the earnings that were coming out, there's actually a surprise of 106%, and there's also a surprise on the revenue as well. Now if we actually take a look at the number, and this is kind of, Celsius is one of the CAN-SLIM stocks in the market right now. So if you take a look at the estimates for next year, plus 54% with the guidance up. So if you look at the EPS year over year, the company goes from losing money to earning kind of 16 cents, 11 cents, 5 cents, losing $2.63. Then in 2021, $1.31, 2024, $2.02. So something is changing there. Then when we come down here and we look at the sales growth, well, 8 quarters ago on a quarterly basis, the company here reported 65 million. Then it went to 94, 104, 133, 154, 188, and in the most recently reported quarter, $259 million revenue. And then the EPS coming in, so the earnings per share on a quarterly basis, 40 cents. That's a real game changer, and it's up 340% on a year-over-year basis. But look how that is a real step change here, because the company on a quarterly basis went from earning a cent to losing 13 cents to 15 cents to 9 cents to 12 cents, losing $2.46 to losing 37 cents, then printing 40 cents per share. So even though 40 cents doesn't seem much, it's very material when you look at it like this. And there was a huge surprise coming through. So it's a stock that's basing, you can see here on the Market Smith weekly chart, it's a stock that's basing on the monthly chart is like a mega cup and handle forming. And then it's kind of EPing an episodic pivot coming out of this base on the back of these earnings. So earnings are fuel. You need fuel and a reason for something to go up. Stocks don't go up because of the pattern. So it's important to remember that the pattern is not the effect. The pattern is not causing it. Sure, you may have some people kind of buying it because, oh, it looks like a flag, it looks like a VCP. Of course, that's going to come. But it's the supply and demand that actually gets these stocks into forming those patterns. So that is not the cause, if that makes sense. So the chart pattern itself is not the cause. It's the effect of the supply and demand balance. Hopefully I explained it a little bit better there. So when we now start looking at Celsius on its EP day, so this is when it is gapping up. So the stock is gapping up from around about 108 and it's gapping up here to 118, so it's gapping up around about $10 or so. Now I'm going to show you the opening range highs on successive charts on the 1 minute chart, but also on the 5 minute chart as well. So we're going to be looking at the opening range highs on these EPs on the 1 minute time frame and also on the 5 minute time frame to get you thinking about the risk versus reward and what it is you are specifically looking for. Now, important to think as well is Qullamaggie saying here, when I take a trade on the short side, which we're not covering, we're covering longs here, I want at least 1 to 5 risk to reward ratio. On the long side, I want 10 times my risk. So the idea for opening range highs is you're using a specific time frame. Qullamaggie will use the 1 minute, 5 minute, or the 60 minute. We're going to be looking at the 1 minute and also the 5 minute chart. If you want to see some on the 60 minute chart, you can go and watch the other video, which is pinned in the comments below somewhere. So you can see here, it gaps up, and what you're looking for is huge volume coming through. Why? Because you're looking for huge volume and positive price action to indicate that large operators, the institutions, want in on this stock. So ideally, you'd like to see the stock gapping up on high volume and then a candlestick like this coming through. So a widespread candlestick that opens near the low, closes near the high, because that's just a visual representation of there is demand for this stock. Okay, great. Now for opening range highs, if you're doing it on the 1 minute chart, you're looking for the first breakout through the high of the first 1 minute candlestick. So the high of the first 1 minute candlestick is 122.12, and then the stop loss would be a penny below the low of the day. So LOD is low of day and SL is stop loss, to abbreviate it, is 118.25. So if you're targeting it through there and your initial stop is here, low of the day, that would be around about 3.17% risk. Now that that there, when I'm calculating 3.17% risk, is imagining that there is perfect execution, like it's absolutely perfect, which is going to be rare. These things are happening quite quickly. You can imagine it's on the 1 minute chart, or you see it going, you go get your order in, potentially trying to get like a buy stop order all set and stuff like that. You're going to have slippage. So this figure here imagines like perfect execution. That's not really going to happen in the real world. So again, you've got to be factoring that in, that there is going to be slippage, things like that. Okay, now what I've put up here as well is the ADR percentage, which is the average daily range. So what Qullamaggie says is ideally he would like his initial stop to be half to 2/3 the ADR percentage. So in this instance here, if we were to imagine that the ADR was 3%, because the math is nice and easy, that would be an initial stop loss of 1.5% to 2%. So 1/2 to 2/3 the ADR percentage. Hopefully that makes sense. So that's a way to try and keep the risk versus reward in check, and also be thinking about that table I showed you, the optimal risk versus reward on a 2-to-1 and also a 3-to-1, and how losses work geometrically against you. So there's the breakout there. Takes a little bit of time to go, and we see this tightness here. I'm going to wax lyrical about supply and demand a lot in this video, be warned, okay? But when you start to see these multiple tight candlesticks, so I use candlesticks, I think they tell you a lot about the price action and things you want to see. So when you see multiple tight candlesticks, especially the real bodies, so what on earth is a real body? The real body is either, you see this green area here or this red area here, that's the distance or the difference from where price opened on that bar to where it closed. So obviously if the open is lower than the close, it's going to be green. If the open is higher than the close, it's going to be red, right? So what you can see here is before Celsius then actually starts moving up here, do you see the tightness that starts to come through? It actually builds kind of a little cup and handle. Look at the tightness in price here. You actually have back-to-back inside bars, and look how the volume stair steps down. So on all of my charts, you're going to see this black line here. This is the 30-day average, or 30 bar average I should say, because we're on the 1 minute chart here, for the volume. So if it's on the daily chart, it's going to be the 30-day average. If it's on the 1 minute chart like this, okay, it is going to be the 30 bar average for whatever chart we are on. I'll explain some of the moving averages as we go a little bit more, but it's black line is 10 EMA, blue line 21 EMA, purple line 50 SMA across all charts. That's what I use. So if we now look at this on the 5 minute chart, okay, so it gaps up, we know this. Now we're using 5 minute opening range highs. So you're looking for a break at the high of the first 5 minute candlestick. So the first high, or the top of the first 5 minute candlestick, is 123.36. A penny below, the lower that bar, is 118.25. So the initial risk on the trade, assuming kind of perfect execution, would be 4.14%, very close to the average daily range percentage of this stock over the last 20 days. So that is kind of maxing it out there. If you think about it, ideally you want to get your initial stop half to 2/3 versus the ADR, really keep the risk versus reward in check. It is all about small losses, big winners, as you're going to see in a quote a little bit later on. So that bar there, through the high of the first 5 minute candlestick, would be the entry. Don't worry, if we do lots and reps of sets, you'll start getting it. So this is IoT. This also has an AI component to it as well. This one is from this year, so it's Celsius. So it's a 4-month base prior to the EP, and it's had a positive reaction to the prior most earnings report. So see the volume coming through, gap up here, pushes up for a couple of days, and then the stock starts basing like this. Then this is the EP. So see how it's breaking out, it's gapping up above the base highs here of about $22.59. Look at the volume that again comes through, look at the 52-week highs. So what was causing this gap up? Let's go and take a look, right? So there was actually a surprise on the earnings side. So the company wasn't profitable, but they lost more money than that. They lost less money than analysts were expecting. But there was a beat here in terms of the estimates on the revenue side of things as well. Now, if we take a look at this stock here, it's relatively new in terms of its IPO. You go price cycle on this, phase 4 decline into a phase 1 base. Now it's in the context of a phase 2 uptrend. And if you take a look at the sales here over the last 8 quarters, it's gone from 101 million to then 4 quarters ago 153 million to now 208 million. So you have, generally speaking, sequential growth quarter over quarter, year over year. That's very, very good indeed, and it's a relatively new IPO. So there's a lot going for this company for it to then EP on the back of that. So if we then take a look here on the 1 minute chart, so the opening range high entry is this bar here, and you can see it takes a little while to go, but just know this is going to be a key concept throughout this video. Like, I'm going to keep rambling about it because I think it is extremely important. Keep looking at what the stocks do, generally speaking, before they then move higher. Okay, so do you see the tightness that generally comes in here and what the volume does before it moves higher? Then over here, look at the tightness come through, look how the volume dries up before it moves higher. Look at the tightness coming through, look at the volume drying up before it moves higher. This is going to be really applicable when we get into flags a little bit later on in part 2 of this video. So you can see here, it actually gaps up from around about 19 to $23-ish. First 1 minute candlestick, okay, then it actually sells off, then it recovers. So the highs of the day, so opening range highs, are then taken out on this bar, but it doesn't follow through. It then takes a little bit of time, it kind of meanders, then it gets going. That's going to happen. Now, if you think about the initial stop loss, if you're targeting it through 23.10, initial stop loss lower the day by a penny, 22.19, that's going to be around about 3.94% risk, assuming perfect execution, which is not going to happen in the vast majority of cases. So you got to be thinking about that. You got to factor that in. Now that's much more favorable. It's about 2/3 versus the ADR of about 6%. Okay, that risk versus reward is a bit more in check. Let's take a look at it on the 5-minute chart. So this is the same EP gapping up here on the back of those earnings where there was a beat. On the earnings side, the company lost less money than the analysts were expecting, and obviously the sales coming in as well. So here you actually get this hammer type candlestick, this shakeout demand tail, then you get this tight little inside bar, and then you get the break, so the opening range highs here through this time 23.14, because that was the high. If you're using 5-minute opening range highs, the high of this first bar here, that was the highs of the day. Then it takes it out, then look how it kind of tightens, and then it starts to go these tight candlesticks. And if you see a tight candlestick, so you see this second bar here, I know I'm rambling, but I really want to try and emphasize these points. You see this tight candlestick, see how the volume versus the 30-bar average is actually elevated. It's maybe like 3 times. When you get a really tight bar like this, think about the concept here, or the context as well. The stock's just gapped up, it's potentially EPing here, okay, on the back of a positive earnings report, or what's being interpreted as a positive earnings report. Sometimes positive earnings report gets absolutely slammed, sometimes what seems negative earnings report actually gets reacted to very well. So it's the market reaction. But the shakeout demand tail tells you there's absorption of supply. Tight inside bar, thin real body on increased relative volume tells you there is absorption of supply. It's all about interpreting supply and demand. This time initial risk would be about 411, which again is about 2/3 versus the ADR. So think about that, keep it in check. There is a indicator here on TradingView. If you search ADR percentage by Armour Schluckler, I think it is, that's the one I use. You can use that. So this is M-phase energy. So this is building a big base. Some of you may recognize this chart pattern. What would you call it? It's kind of 2, isn't it? You could say it's a VCP. You have 1 contraction, 2 contraction, 3 contraction, 4 contraction, maybe 5 contractions, and then the pivot here is kind of 220.99. But it's pretty darn choppy like this. M-phase energy, many solar stocks actually trade more like commodity stocks. They tend to be a bit more choppy. But here you can see it's gapping up. This is the EP. It's gapping up above this level here. So the stock has been basing for about 4 months, and then it is gapping up above it. Let's then go and take a look at what the earnings are. So remember, companies will report after hours, or they will report pre-market as well. So you got to be on it. You got to be focused. So here you go. This is the earnings coming through. So it's actually this bit in here. Okay, then M-phase energy kind of goes and then rolls over. But if we take a look here, what was going on? Well, there was actually a surprise on the earnings. So the estimate was for 86 cents, and the reported that came in was $1.07. So there's a 24% surprise there. And then on the revenue, it was estimated the company was going to earn 509 million, but what was reported was 530 million. So a marginal beat there of 4%. If we take a look here, it was firing on a lot of can slim cylinders, if not all the can slim cylinders at this moment in time. You can see the estimates here. So the company on a yearly earnings per share estimates, okay, 10 cents, 95 cents, $1.37, $2.41, $4.62, $5.15, $7.57, with the guidance coming in as well. Earnings per share growth rate, that's a 3 to 5 year look back, 168%. That is ridiculous, like ridiculous on a company of this size with a market cap of 23 billion. Then we take a look down here, the ROE, 103%. Then this is it here. This is the earnings report coming through. Earnings were up 102% and sales were up 68% on a year-over-year basis. Like, that's what you're looking for. Huge earnings, huge sales, huge growth rate, huge ROE, big beat on the earnings, and preferably the revenue side of things as well. That's what you're looking for, and huge guidance coming out. Maybe the company raises full-year guidance or something like that as well. So there's actually a reason for this stock to then go high. The market is reacting to the new news, the new information becoming available. That's a very Bayesian mentality the market has. The market is the most Bayesian thing out there. So Let's then take a look. So the stock in this instance here is gapping from about 217 up to around about 235, 236, something like that in there. So you get this kind of doji bar, which for the first 5-minute bar. I couldn't go back far enough for the 1-minute chart on Enphase Energy on TradingView because you're only allowed to go back so many bars. So it's just going to be a 5-minute chart. A doji bar tells you what about supply and demand? It tells you there's indecision, isn't there? It's clear there is indecision. But then who wins? Well, on this 5-minute bar here that then takes out the opening range highs, and the opening range highs is the high of this bar here, which is 239.40. Who wins? Demand wins. So the entry is this bar here, initial stop loss penny below 228.99. So then the risk would be about 4.35%. Now if you look at that relative to the ADR, it's more than the ADR. So you've got to then be thinking about it. You've also then got to think about the probability. So as Qullamaggie said in that quote earlier, he's looking for 10 times his initial risk. So then the question is, okay, is a little bit out of check relative to the ADR. Do you also think there is a realistic expectation or a realistic chance that this stock could go up 10 times your initial risk? So i.e. if you are risking $1, could it go up $10? If you're risking 4%, do you think it could go up 40%? That's a question that you have to ask yourself. Let's do a few more. This is SMCI. This one here is up like over 100% from this EP. So SMCI basing for circa 2 months before the EP. So do you see how the stock is in the context of an uptrend, strong uptrend? So on my charts, I use the black lines 10 EMA, blue lines 21 EMA, purple lines 50 SMA, just the simple. The grey line is the 100 simple, and the red is the 200 simple day moving average. So do you see how the stock is in the context of a nice uptrend? Then it starts basing, and then it breaks out, and it's attempting to break through the highs of the base, 119.24. And then you can see the volume that comes through. You can see the 52-week high come through as well. So let's take a look at this, because this one is a little bit paradoxical. So now when we go and look at the earnings that came out, well, and this is a quote, sometimes bad news, or this is my own quote, sometimes bad news, material slowdown in earnings and sales is reacted to positively. So if you're just looking at the earnings, it may not make any sense. Like, why is this stock doing this? Why is it doing this when the earnings that came out were plus 5% year over year, the sales were down 5% year over year, they missed on the earnings and they missed on the revenue? It doesn't make any sense, does it? But what did the market do? It did that. So this is about following the price action, following the opinion of the market. Sometimes you can have what seems a pretty mediocre and or bad earnings report come out, but the stock is gapping up and it's powering out of a base. Other times you can have what looks to be a fantastic earnings report. There's a huge beat on the earnings, there's a huge beat on the revenue, the company raised full year guidance, and the stock gets slammed. Such is the nature of the market. I can't explain it. The market does what the market bloody well wants to do. So let's take a look. This is on the 1-minute chart. So you have a stock that gaps up here from about 106 to 116ish, and you get a nice close on the high of the bar for the 1 minute candlestick. So you get this little shake out demand tail, closes on the high, then it takes it out here. So this would be the entry. Now it kind of ums and ahs for a little bit, doesn't it? It pulls back down, and then you get this really tight bar. See the tightness in price, but the volume ticking up. Remember what I told you about absorption of supply. Tight bars like this, given the context, the stock is just gapped up here for whatever reason. Some institutions absolutely want it. So see how it starts to tighten on high relative volume. That's absorption of supply given the context. So the entry is here. The initial stop loss would be 114.31, penny below the low of this bar. That's about 3.31%. Now relative to the ADR, that's much more favorable. It's around about half the ADR. And then the question is, do you think there's a realistic expectation that you can make 10 times your money on this entry? That's something that you have to decide kind of in the moment as it's playing out as well. So clearly EPs, you have to be looking at your screen. You cannot do it passively. You have to be looking at your screen, executing it as price is doing certain things. Huge relative volume coming through in the first 1 minute bar as well. Let's take a look at it on the 5-minute bar. 5-minute time frame. Huge relative volume coming through. Great. You get this doji candlestick. Doji signals indecision between supply and demand. Who wins? Demand wins. So the high, the opening range highs on the 5-minute chart is 118.76. Penny below the low of the 5-minute bar would be 114.31, same as it was on the 1-minute chart, 3.75%. That's still favorable relative to the ADR percentage. So here is an important slide. Episodic pivots can happen on non-earnings news events such as FDA approval, award of a new contract, new partnership, collaboration, etc. This news can create episodic pivots on volatile stocks like small and micro caps. Sometimes there is no apparent news and the stock could be gapping up because it's in a hot theme, which is periodic, such as artificial intelligence, which is very hot at the minute, COVID vaccines, very hot a couple of years ago, EVs, very hot a couple of years ago. Crypto stocks, very hot a couple of years ago. So sometimes, well, the market invariably always has kind of a hot theme. At the minute, it's obviously artificial intelligence. It's not always going to be AI, but at the minute, it's AI. So stocks with any kind of AI news or potentially sympathy plays as well. So a stock can also be gapping up as a sympathy play to another stock. So stocks are often brother-sister stocks. Jesse Livermore, in his book, How to Trade in Stocks, he would talk about tandem trading. So if you imagine, say, semiconductors, if you looking at Nvidia, it's probably worthwhile looking at AMD, because if Nvidia brings out some really important news, AMD may be gapping up as kind of a sympathy play to that. Hopefully that kind of makes sense. So sometimes a stock can gap on no apparent news. Now these smaller and micro caps they are kind of micro caps, right? But these smaller and micro caps can be very volatile in nature. So this is CXAI, more of kind of a AI play. There's no obvious news, but this stock was able, from this gap up that opened on the low and powered up here, went up over 600% in 2 sessions on no apparent news. Now, obviously, this is extremely volatile, and stocks like this have a much higher ADR percentage. So the risk is going to be much higher. So remember those tables that I showed you earlier on about how losses work geometrically against you. It's so important to think about that. So here, CXAI, it's just a crap company, right? There's no earnings, there's no real sales coming through. It's just terrible, right? So you will see these EPs in these just tiny companies. The market cap is 92 million. Like, it's a speck. It's an absolute speck. So here you go there. So it gaps up pretty significantly from $1.65 to around about $2.80-ish. So what you see here is you actually get this little Davis box coming through in here, but the opening range highs, it actually takes it out here at $2.95. So again, it's not that clean, and I'm going to show you some failures, because you may have just watched the first however long of this presentation and be like, oh, the EP, they look really easy, they're never going to fail. Of course they are, right? So I'm going to show you some failures as we go. You are going to get stopped out. Some of them are just probably way too volatile to go anywhere near. So in this instance here, okay, it gaps up. You get a decent first 1 minute candlestick. The highs of the day, so the opening range highs, the price you're looking to be taken out is $2.95. Stop penny below that is $2.69. Now that stop loss there would be 9.12%, assuming perfect execution. Now perfect execution on a smaller micro cap is even more rare than if you're trading a Celsius on a gap up, an SMCI on a gap up, an IoT on a gap up that is a larger cap company, right? So really think about that. Sometimes the spreads can be just wild on these smaller and mid caps. So it is extremely volatile. Do not think this is easy by any stretch of the imagination. You nearly get stopped out here, and then it turns and reverses. I'll show you that on the 5 minute chart. So here on the 5 minute chart, kind of ums and ahs, you get a weakish looking doji type candlestick coming through, massive relative volume coming through, like ridiculous volume coming through in here, and then the opening range highs takeout is here at 305. Stop loss penny below 269 would be 12%. Assuming perfect execution. I'm going to stop saying perfect execution. Hopefully you get the point about perfect execution. Very rare on smaller micro caps. And then it starts moving out. Look at how it pulls back in here. You know, I was talking about earlier, before stocks break out, especially in the flag type, especially in the flags, like, I'm going to just go on and on about it, because I really want you to take this away. Do you see the tightness in price before it breaks out? See that? Look at the tightness. Look how the volume dries up. Here, do you see the tightness? Do you see how the volume dries up? These tight candlesticks, especially when the volume dries up, tells you that there's very little supply coming to the market. And when we start talking about the flags, it will also tell you, or it will also enable you to take tighter risks, because your expectation is, well, the high of this bar here, which can often be an inside bar, should be taken out and stop loss lower that bar, because your expectation is price should just break through the high. I don't want to own it if it's below it. Make sense? Let's do some more. So this one here is CXAI. I've just zoomed out here and showed you the 5 minute chart. So this is the opening range highs here. Now from that entry, it goes up about 500%. Okay, this is the session, and then this is the open of the next session. So imagine if you put your stop loss lower the day and you were using the 5 minute chart. If you went lower the day, we're going to talk about sell rules a little bit later on. I covered them extensively. I'm now just giving you kind of the entries. Qullamaggie would be using the 10 EMA, selling part of the position in the first 2 to 3 days. I'm actually going to teach you about free rolling, which I think is kind of a really optimal way of thinking about that part of the process, but riding the 10 EMA. But if you've got a 500% gain in the space of under 24 hours, like, well, 24 hours from when this opened, from basically when you bought it to now, think about it, right? So I'm going to be teaching you about lower the bar. Got a little bit ahead of myself, but teaching you about lower the bar and or low of the day, okay? We'll come on to that a little bit later on. I would recommend watching this video twice, then it may click a little bit more. But getting the monsters right, getting the home runs right, as I put in the quote on the very first slide of this presentation, Qullamaggie is a home run trader. Trying to get the really big ones right and sit in it, key. So here we go. So this is their, I think you pronounce that, Mudra Band, which is AI-powered touchless sensing wearables, now available for the Apple Watch. So again, this here is a tiny company. It's obviously a phase 4 decline. You could say, well, maybe it's building this base in here, but it EPs here on the back of this news. So something to do with Apple, with their Apple Watch, and it's a little bit kind of AI, which again is a strong theme in the market right now at the time of filming, but it gaps up and then pushes up. So if you were then riding, say, the 10 EMA and you bought it in here somewhere, opening range highs, then you'd still have this, where I cut this slide off, you'd still have part of it back there. But you can see a lot of these are then kind of micro caps, tiny companies. So $28 million market cap, no earnings, no sales coming through. A lot of these can be very, very pump and dumpy as well. They kind of just go up for a little bit and then they just come crashing back down to earth very, very quickly. It's not like a company that has, like a Celsius, they have huge earnings, huge sales, they have potentially a global product on their hands as well. Their ROE is very good, it's got institutional sponsorship. This is very, very different EPs, but I wanted to cover them in this video as well. So this is WLDS, so this is the 1 minute chart for the opening range highs. So it gaps up from, what's that, that's 49 cents, something like that, to around about 78 cents. So again, penny stock, okay? So it gaps up, pulls back down to here. So the opening range high takeout will be 0.7889, which is here. It starts breaching it and taking it out here. So here would be the entry. Penny below would be 0.6490. Now, what do you notice about the stop loss? 17%. Think about how losses work geometrically against you. So even though you're like, oh, it worked really well, it went up like a double or something, yeah, but you have to take 17% initial risk. Like, do you want to take 17% initial risk over the course of 100 trades, 1,000 trades, knowing how losses work geometrically against you, and your win rate may be somewhere between 20 and 30%? Probably not, right? So again, you really got to think about that. So yes, there can be EPs on these stocks that look, oh, it's great, it's gapping up, it's got this news coming out, yeah, but your initial stock might be like 17%. Think about it. So 5 minute chart here, gaps up, here's the doji type candlestick, opening range highs takeout would be here, initial stop, penny below is 17.85%, same as on the 1 minute chart. Now this one here, they had a positive phase 3 trial data come out for a ovarian cancer trial drug that they are going through. So the stock gaps up here around about 100%. So this is one where it's actually a bigger company. So the market cap of this company is obviously increased because the stock has done this, but it's about $4 billion at the time of taking this print screen. So it's not an absolute micro cap of a company. I would say the kind of micro cap companies, really be thinking about if you even want to consider it. Study them, see how they kind of move, but certainly like trailing some with a 10 EMA on when you start getting into the mid cap, into the maybe the small caps, but into like the mid caps and the large caps, and it's the context as well. Is it potentially a new blockbuster drug coming out which has just like changed the game for this company? Is it, say, a company that's been basing for 6 months and it's just come out on the back of a monster earnings report? Then you may want to try and sit for the intermediate or the shorter term trend, being say the 10 EMA and the 21 EMA. You've got to consider that. So the sell rules are then applicable for which stocks you are trading. We're going to cover sell rules much more in the second part of this video, which when we look at flags. So here's the gap up. Let's take a look at what it looks like. So it's a biotech related stock. Okay, there's no earnings coming through. That is usually the case with biotech stocks. There's some sales coming through, but it's really on the back of that phase 3 data announcement. So this is the 1 minute chart for IMGN. So it gaps up from around about, I can't quite see what that was down there. Let's take a look. So it's gapping up from around about $6-ish, and then it's gapping to about $10.50. Something like that. So here is then the opening range highs. So here you actually would have been potentially in a little bit earlier, actually, how I've kind of drawn this. So ignore that, I've messed this one up. But in here, I think that would be for the 5 minute chart. Oh, there we go. I did it wrong. Sorry about that, guys. So we'll just do this one on the 5 minute chart, okay? So the opening range highs would be here, $11, and then the initial stop loss would be a penny below the low of that bar there, which would be $10.30. So your initial risk is about 6.5% if you were buying it like that, assuming perfect execution. The average daily range being about 5.59%. So you've got to consider whether or not that makes sense, and you really you realistically think you could get a 10 times move, 5, 10, 15 times move on 6.5% initial stop. And you can see it actually sells off really hard, nearly stops out, and then it recovers thereafter. Let's do another one. So this one here, again, when there's no obvious news and you get a penny stock gapping up like this, and it's got a tiny market cap, like micro cap company, it's much more usually just pump and dump. Like here you can see pump, dump, pump, dump. So here, what's the character of the stock? Well, it looks a little bit pumpy and dumpy, and there's no obvious news on the stock that I could find. But it goes up nearly 500% from this gap here, from the low of this gap here, in a couple of sessions. So let's take a look at it. $57 million market cap. Okay, there's some sales coming through, but it's like 100 grand. It's nothing that's coming through. So these ones here, this AHI is very different to IoT, to SMCI, to Enphase Energy, to Celsius, right? So 1 minute chart, okay, it gaps up from about 35 cents to, what's that, around about 60, 62 cents, something like that. So the opening range highs is 0.67%. Sorry, it's not even 67 cents, it's 0.67 cents. And then in here, it's then stop loss would be 0.6000. That's 11%. You can see like these micro caps, but you do get these opening range highs on them. They can be ridiculously volatile. Do you really want to have an 11% stop loss over the course of 100 trades, thousands of trades, 10,000 trades? Probably not. Here's what it looks like on the 5 minute chart. Again, just trying to help you with the pattern recognition skills of, here's the opening range highs, so it's through the high of that first 5 minute bar, stop loss, penny below, there's the entry, and then do you see how it pulls back in here? Look at the tightness in price. So tightness in price and declining volume and or higher volume, but still the tightness in price tells you there isn't much supply coming to the market, or supply that is coming to the market is being absorbed. But here on the 5 minute chart, do you really want to have a 21% initial stop? Probably not. And also, you're probably going to get slippage on the execution going in, and you're probably most certainly going to get slippage as it starts taking out the lows of the day. So that there, 21%, add 5-10% to that. Like, seriously. This one here, this is TRVN, so this is an EP, but you can see the stock here is in the context of a downtrend, and then where does it fail? Well, it fails into the 200-day moving average. So do you really want to be trading stocks that are in the context of long-term downtrends and then kind of gapping up into moving averages or significant overhead resistance? Probably not. So I think the more ideal ones are those classic can-slim stocks that have much more liquidity to them. They actually have earnings and or very high sales coming through. So you have like a Celsius has the earnings and the sales. Say like an IoT, it just has the sales coming through, but potentially the stock is trading on the expectations of future earnings to come. That can be a significant driver for the stock. But playing in the mid cap, larger cap, mega cap areas of the stock, maybe not so much mega caps, but certainly the mid caps and also the large caps, when they're building those multi-month bases and then breaking out above the resistance levels, above all the key moving average, I think is much better than looking at these kind of crappy penny type stocks. They're in long-term downtrends and then gapping up into long-term moving averages that are declining, such here, the red line, 200 SMA. That's exactly where the stock stalked. But let's take a look. There was Chinese drug approval, so there's some news on this stock for why it is doing what it's doing. But the market cap, 11 million. Okay, so really think, if you're running your scans and stuff like that, really think about the context of the stock. Really think about it. So here, this is the 1 minute chart. So the stock is gapping up. Highs of the day, so the opening range highs is 0.83. Stop loss, penny below, or kind of marginally below, not even penny below, would be 0.76. That's 9.5% risk, assuming perfect execution. So the entry is then here, opening range highs, ums and ahs for a little bit, then it gets going. Then what do you notice? Look at this. I know I keep rambling on. Like, take this away from this presentation. Look at this bar here. Look how tight it is. It's an inside bar sitting on the 10 EMA for the 1 minute chart, and look how the volume is just stair-step down here, and then it breaks out and goes. Like, what is this bar telling you? What is it telling you? It's telling you there's hardly any supply coming to the market. Then what I'm going to be teaching you a little bit later on is using buy stop limit orders through the highs of bars like this, stop loss placed underneath, and then free rolling it, removing the risk really quickly. That's what we're going to do in part 2. I think you're going to enjoy it. Actually, maybe that's part 3 actually. Maybe, no, I think I can't remember. It's part 2 or part 3. We'll get there, right? So this is TRVN. This is on the 5 minute chart this time. So you can see here, gaps up. So the opening range highs is where? 0.9, penny below, not quite a penny below, 0.76, just below the low of that bar, but it's 16.5%. Do you want to have initial stops 16.5%? You probably don't. So if you're trading then these kind of just micro crappy companies, you probably want to think about trailing a long shorter term moving average, because it is not a Celsius breaking out. It's not an Enphase Energy breaking out. It's not, right? They're ridiculously volatile. Can't stress that enough. MBOT. So its Liberty Surgical Robotic System achieved 100% success rate in extended joint preclinical animal study. So there is news for this. But again, similar to TRVN, the stock is in the context of a long-term downtrend, and then it is EPing into declining moving averages in the context of a long-term downtrend. So again, the context of where are you seeing it? Where is the stock in its price cycle? Is it kind of like a leading stock? Qullamaggie calls them momentum leaders. Is it a momentum leader that's been basing for a couple of months, maybe like 2 months, 6 months, something like that? Big old base building, which can mean a lot of accumulation, and then it's EPing above, so a gap up breakout above all the overhead resistance, above all the moving averages, and it's going. This here, the context from a price cycle standpoint is very different. So then using like the 10 EMA on a stock like this, I think about it, right? $27 million market cap, no earnings, no sales, and just take a look at the previous character of the stock. So something you want to do, even on, take a look at like the Enphase Energies of the world, the Celsiuses of the world that we looked at the EPs. It's not the first time those stocks have EP'd successfully. If you take a look at the character of this stock here, which is MPOT, like, do you see how it's just pumpy and dumpy? Right, it goes up, comes back down, goes up, comes back down, goes up, comes back down. Like, consider the behavior of the stocks, because stocks like humans have repeatable behavior characteristics. If it is pumpy and dumpy in the past, it's probably going to be pumpy and dumpy in the future. Stock's telling you its personality. So really then think about that with then kind of sell rules around it if you do want to trade such a volatile stock, right? So this one here, gaps up from about $1.21 to what's that, $1.90-ish, and then the highs of the day are here. However, this here on the 1 minute chart, you have likely already entered and got stopped out, because if you see the first candlestick here, okay, through the highs there, you would have been in here, then out here. So you would have been stopped out within the first minute. Then it resets back up a little bit later on. So then the opening range highs then becomes through 198 with a stop loss penny below the low of the day, 160. That's 19.5% initial stop. 19.5% initial stop. Don't be anywhere near it. MBOT, it's obviously not financial advice. I'm just a guy on YouTube and I have no idea what I'm talking about. Do your own research, all of that stuff, right? Opening range highs. So here on the 5 minute chart, it's going to be the same levels, 198, 160, 19.5%. So here, this is then the one that I showed you earlier on in the presentation. So did your eyes then get drawn to here on the 5 minute chart? See the flag that forms here? You could also think of it as kind of like a VCP, so volatility contraction pattern with a little low pivot, low cheat forming down here. You could also look at it as a nice flag type pattern. You could also look at it as a Davis box type pattern. It's basically all the bloody same, right? You're just trying to understand things from a supply and demand perspective, understand when the stock has potentially given you a favorable spot to take a risk versus reward trade where you think you can risk $1 to try and make $5, $10, $20, $50. That's what you're doing. That's the whole point of looking for setups. So here, look how tight it gets. Look how the volume dries up. Here, look how tight it gets. Look how the volume dries up. Really good. Now here is obviously a very clear change character on the 5 minute chart, slicing through the 10, 21 and the 50 moving average. Let's do another one. ATTO. So yes, this stock kind of EPs, but look, there's no obvious news on it. And what's the context of the stock? It's in a long phase 4 downtrend, and then see where it fails around this 200-day moving average. So let's go and take a look at it. Durable company, $21 million market cap, marginal kind of earnings coming through. Okay, there's some sales coming through for this company as well. It doesn't really make sense to me how a company could have sales of 364 million but only have a market cap of 21 million. Something doesn't sound right there. But if you look at the behavior of the stock, so again, look at the behavior of the Celsiuses, the Enphase Energies, the SMCIs, the IoTs, so on and so forth. Have they successfully EP'd in the past? And then go and take a look at a company which is potentially EPing because it's gapping up in the pre-market, and maybe it's on significant news, maybe it's on no apparent news. What has it done previously when it has behaved like this? Is it just terrible, basically in the context of a long-term downtrend, and it just kind of gaps and fades, so gaps and craps. It just basically is pumpy and dumpy. This stock here looks ridiculously pumpy and dumpy. So here, there's also like no liquidity coming through. Look at this, like it's not trading anything. In the first 1 minute, it trades under 50k dollar volume. maybe $100K volume. Like, it's just not trading. There's no liquidity there. So the spreads are going to be like probably like 3% wide as well. So your round trip in spreads is like 6% before you even consider it. So why am I including so many like this? Because I'm trying to tell you not all EPs are the same. Really, really, really important you understand not all EPs are the same and you understand the context difference. So here the opening range highs would be through $1.73, initial stop loss penny below 165. Okay, that's more favorable in terms of the risk versus the ADR. Now this ADR is not backdated to the time of this stock here. It wouldn't have been 24.5%. It would have been a little bit less, but that there, if it was, would be a very good metric because the initial stop loss is about 5 times less than the ADR. Make sense? That's what you want to see, 4 times less. So ATO, here it is on the 5-minute chart. So it gaps. There's the opening range high, stop loss penny below, and then you see how it moves up here. Then you get this clear change of character. But the stock goes from $1.70 to about $3.40-ish in a day. Then this clear change of character bar. So be aware of these change of character bars. We're going to talk about those when we go on to the flags and the optimizing profits. Okay, this one here, slightly different here, because the stock's in the context of a longer term downtrend. So context, right? Context. Stock is in the context of a longer term downtrend, but it's potentially basing like this rally in here that then fails at the declining 200 SMA. You've seen a lot that failed at the declining 200 SMA. So it fails into that and then it pulls back down, and you could maybe look at this as a bit of like a phase one. It's got that kind of like basing pattern to it, but you certainly need to see like a breakout. So it actually gaps above all of these moving averages. So it gaps above, and then there's some news. Circa $80 million share buyback. So this is one where, okay, maybe this makes a little bit more sense to potentially trail some on, say, the 10 EMA being this black line. Or as I'm going to teach you, lower the day, lower the day, lower the day, lower the day. Or maybe you're using an intraday moving average. Again, go and look at thousands for yourself, create your own rules around it, but understand the context of the stock that you are trading. So when we go and look at this stock here, market cap of 160 million, it's another biotech, so it's going to be extremely volatile. Look at the price behavior of the stock previously. Look how wild it is. Ask yourself, do you even want to be involved in a stock that has this price behavior historically? Ask yourself, do you want to be? It's key. 1 minute chart. So it gaps up from about $3.40-ish, $3.50-ish, opens here at around the high 390s. So 1 minute opening range highs would be $4, nice round number, and then penny below would be 394. Now we have a really tight stop, 1.78%. Nice, relative to the ADR of 9%. Nice, now that's much more favorable. See this bar here before the opening range high breakout. See how tight it is. See the increased volume. That's absorption of supply. It's absorption coming through. And then look at the tight bars. Absorption of supply. That's what you want to see. 5 minute chart, opening range highs. So here it is, opening range highs of the 5 minute chart, be 420, stop loss penny below, 394, initial risk on the trade 6.36%. So think about that relative to the ADR. Take a look at the volume coming through. Think, is there a realistic chance here I could risk $1 to make $5, $10, $20, $50? Ask yourself, right? The STM. So this one here, positive updated data on ovarian cancer therapy. So that is the reason for this stock to be gapping up here. I think it actually kind of came out during the session just for how the kind of volume moved on this stock, but potentially a phase one base. Like it started to base from October to May, June-ish. It's been building higher lows. It's slightly tightening, but it is below its declining 200-day moving average. You would still say up until this point here, the stock is in the context of a phase 4 decline. But let's go and take a look at it a little bit more. So market cap 165 million. It's a micro cap. Look at the previous behavior of the stock. Do you want to be involved in a stock that's been behaving like this? Is it going to be an easy one to kind of manage from a trade management perspective? Go back and look. It may be, it may not be, but that I think is a key part of the research. How has the stock moved previously? Really think about it. So VSTN, you can see, first thing, 1 minute chart, like it's not trading anything. Like, look, it's so illiquid. This is another thing that you have to think about is the liquidity of the stock. Okay, it's like a $6 stock, but there's no volume coming through. So the spreads are going to be like that, like a meter wide. The spreads are just going to be ridiculously wide, so you're going to get huge slippage. But so think about it. So what I've really tried to do in this presentation so far on EPs is explain to you not all EPs are the same. Just because a stock is gapping up on news of potentially an FDA approval or this or that or whatever it may be, they're not all the same. The context of the stock is so important for you to be thinking about. So in this instance here, the opening range highs took a bit of time, 606. Stop loss penny below would be 551. There's the breakout. Then it starts to go. 5-minute chart, that's what it looked like. So 606, 551 be the same. Risk 9.2% relative to the ADR, about half. Be thinking about it. Not the hugest of gap ups here, only about 12%. Well, that's actually to the high of the bar there, and then it kind of sold off. It's not a great one, right? Again, this one here, US patent linked to a prodrug for anxiety. So this stock here is in the context of a longer term decline. Huge relative volume then does come through. Here it is. Here's the news for it. Let's go and see what was going on. So market cap 7.7 million is an absolute flea. And if you look here, it's clearly in the context of a long-term downtrend. It's a bit kind of like pumpy and dumpy like this, so really do be thinking about it. Here it gaps up, there's high relative volume coming through, so the opening range highs would be through the high of the first 1 minute candlestick. If you're using the 1 minute chart, 226. Stop loss penny below 201, that would be 11.67% risk, assuming perfect execution. That's pretty wide in terms of the risk parameters. On the 5 minute chart, it would be the same 11.67%. Through the highs here, 226, stop loss penny below 201. You can see you nearly would have been stopped out here, and then the stock turned around and went. So some of them will be big winners, some of them won't be big winners. It is what it is. Let's do, I think I've got about a couple more of this, then we're into the flags, which will be part 2. So positive earnings reaction coming through here, but you can see the character of the stock. So this is the EP that we're looking at over here, okay? Huge relative volume come through, but what's the previous behavior of the stock? Pump and dump, pump and dump, pump and dump, pump and dump. What's it more likely to do? Pump and dump, right? Look at the behavior of the stock. So even though the stock comes out, and on the face of it, it's pretty impressive. Like the earnings come out 211%, the sales are up 283%, but the character of the stock is very much pump and dumpy. So I think a key consideration is the stock, what is the character of the stock? What is the stock doing? What has it done previously? How does it usually behave? Because that's probably an indication, or it is an indication of how it is going to behave in the future, in my view. HDCR. So here it is on the 1 minute chart. So opening range highs would be through the high of the first bar in this instance, because that was the high of the day, which is 205. Stop loss 184. That would be about 10.5%. Think about it. Is that a favorable risk versus reward? Then look at this over here. See how it starts to tighten? See how the volume dries up? Then it breaks out. That's what you're going to learn in the flag section. This is the 5 minute chart. So not a great first 5 minute candlestick, and then there was really good volume coming through as it took out the opening range highs here, and then see how it goes tight, 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 nearly, well, it's back to back inside bars, and then the stock breaks out. That's what you're going to be learning about in part 2 for the 15th time. So most cowboy, I just call them cowboy, I'm not looking to offend any cowboys, but most cowboy episodic pivots won't work. The above slides may have made EPs look easy. I tried to make them not look easy by telling you about the character of the stock and stuff like that. But it's a high risk strategy with an expected win rate of under 50%. Therefore, understanding optimal risk versus reward ratios and risk management is essential to even consider such a strategy. The following slides show several EP failures. I think it's important in a video like this, you see some failures, because not everything is dandelions and roses, right? So here's one, identify. BMPR, or BMR even, don't know where the M came from. So leverages NVIDIA's video coding, NVIDIA ridiculously strong stock, video encoding technology to speed up video optimizing process of AI generated videos. So it's gapping up here, it's pretty new in terms of its IPO. It's got kind of NVIDIA in that title, which is ridiculously strong stock. It's got AI in that title, but here you go, gap and just fade. But would you have got triggered? So here you go. So the opening range highs here on the 1 minute chart would be through 660, because there you go. So it's a very good first 1 minute candlestick. It's very, very good. Look at the volume coming through. Look at then the volume coming through, pushing it up a little bit higher as well. Albeit this is a Wyckoff concept of effort versus rock. You have really high effort being the volume come through, but price hardly goes up. That's not a very good sign. That's in supply in that bar there. But you do get triggered here, and then initial stop loss penny below would be about 12%. And then you get stopped over here. Again, not everyone is going to work. Qullamaggie quote, if I get stopped out, I get stopped out. I don't think, I just get out. Here is it on the 5 minute chart. So 5 minute chart takes around about 4 or 5 bars for it to get triggered. So the high of this bar is 744. Stop loss penny below would be 579. So that would be 22% initial stop loss. No. That would have been the opening range highs. Really, really think about it. Then you stopped out with a 22% loss. Think about the risk versus reward. It's ridiculously important. This one here, this is AI, it's gapping up. Now you could say it's trying to like gap up out of this base as well. It has kind of run up here from about 16 to 33, so it's up like already 100% before this kind of comes out. I don't know if that's kind of the best, but it is a little bit of news there that the C3 generative AI now available on AWS, so Amazon Web Services. Let's take a look at it. So market cap, this stock is like a real kind of hot theme, not necessarily, well, it is kind of a meme stock at the minute because the sales are pretty terrible, the earnings are non-existent as well. You could say it's maybe coming out of a phase 1 base into a phase 2 uptrend. There's obviously massive volume in it, market cap of 4.22 billion, but here we go. So you would have got knocked around a few times on this stock and it probably would have annoyed you. So first opening range high entry, because here price actually takes out the highs of the day. So here, if you're really quick on it, you're coming through here 37.75 and you're like, oh, it's going, you get in, and then 1 minute later you get stopped out. Literally 1 minute later you get stopped out for a 3.5%, 3.45% loss. Okay, the loss isn't kind of that massive. And then here, second opening range high entry. So here would be your entry, it kind of goes and then you get stopped out down here. Probably not the best, right? Irritating. It's going to happen, right? It's not all dandelions. Opening range highs, this is on the 5 minute chart. So here you don't get kind of whipped around as much as you do on the 1 minute chart. The opening range highs would be through the high of this first 5 minute hammer type candlestick, 375, and then 37.75 stop loss, penny below 36.17. It goes and then you get stopped out here for a 4.22% loss. So again, that's more kind of favorable if you think about the initial stop loss placement of about 4% relative to the ADR of 13%. Okay, that's kind of better in terms of the risk versus reward there. It's around about a third or so versus the ADR percentage. Okay, that's better. We're not going in with like initial stop of 25%, right? So NONX received FDA clearance to market products including X-ray systems. So you can see it's still in the context of a long-term downtrend here. Okay, gaps up. It has got its declining 200-day moving average, potentially a psychological level of $10, maybe not, but gaps from around about $6 up to about $8.50-ish, about 45%. And then you see here effectively goes along its 10 EMA, and I'm going to teach you about going lower the bar, potentially choke it off all or some of the position when you think the stock is extended. I think that's an effective sell tactic I use myself. So okay, just getting into kind of smaller cap territory, $1 billion market cap. You can see pretty kind of choppy in terms of how it's previously been trading. It's a medical systems equipment related stock. No earnings coming through. There's a little bit of sales coming through, but potentially that FDA clearance for one or more of their products, potentially a bit of a game changer for the company. Time will tell on that one. But even here, the 1 minute chart, okay, well, you would have been stopped out on the first opening range high, so it's not easy. So you see here, gaps up, little kind of supply shoot doji type bar, huge relative volume coming through. But here, if you were in here, you then would have been stopped here for around about a 5% loss. It then resets, so there's another opening range highs here. When price then takes out these highs of the day, which is $9.79, then initial stop loss, penny below the low here, $8.55 would be around about 12%, 13% initial stop. Do you want to do that over the course of 1,000 trades? Really think about it. Really think about the risk versus reward. Average daily range of 10.72%. On the 5 minute chart, you would have had the same thing where you have the first opening range high entry, you then get stopped out down here, it then resets later on in the session, $9.70, $9.79, and then $8.55 initial stop, penny below the low of the day. That would be again 12.7876%. Do you really want to have that as your stop loss? So now we are into part 2, where we're going to be looking at flags, and I'm going to be teaching you about buy stop limit orders and attaching the stop losses for order entry. So Qullamaggie does not do this. He uses opening range highs, but I thought in this video it would be effective. Certainly if you are not able to look at the screens, you have work commitments, you have family commitments, you just don't want to stare at screens, time zone, whatever it may be, this is how I enter positions. Primarily I use buy stop limit orders and attach a stop loss. So whilst we're talking about flags, I think many of you, it may be information to hit. So here we go. Let's go. So flag breakouts using a different entry order technique for when price doesn't gap significantly above the pivots. It's all about small losses and big winners. So here you go. This is basically a flag with 1 contraction, 2 contraction, 3 contraction, 4 contraction, 5 contraction. Now for flags, I know there's different variations. There are bull flags, there are pennants, whatever. I'm just calling them flags, right? Here we go. Let's get into it. So what I'm going to do first and foremost is teach you about buy stop limit orders, and I'm very well aware that this is a cup and handle, not a flag, but it's a very good recent example that I'm going to be taking you through. So this is a daily chart here, so it's a cup and handle, and it starts tightening in the handle, puts in this tight inside bar on low relative volume, and then breaks out. So I just want to teach you about buy stop limit orders and explain the concept to you. So we're going to go down to the 1 hour chart, but remember the high of this, what I call trigger bar, which is tight inside bar signaling, there ain't much supply coming to the market. So 17 75.90 and then 74.22. So here you go. This here, these vertical dash lines, these blue vertical dash lines represent the session. So remember the points that we had, 75.90 being the high of this day here, and then the lows of the day here being 74.22. So there you go, 75.90, 74.22, right? That is the boundaries of that quote unquote trigger bar, that tight inside bar. So if you're then using a buy stop limit order, this is how I do it. So the buy stop is the trigger price. So the trigger price in this instance is 75.90, and then the limit determines how much you're willing to pay for any shares. Primarily, I will go somewhere between 0.5 to 1%. It depends on the market environment, depends on the liquidity of the stock, depends how much I like the setup as well. But somewhere between 0.5% above the pivot and 1% above the pivot. So let's work it out using a 1% limit on the buy stop. So basically the order looks like 75.90 is the buy stop. So that then means if price goes through that level, your order then goes to the market, but the limit is telling your broker how much you are willing to pay for any shares. Do not pay any more than this for the shares. That may mean that you don't get filled on the entirety of your position. Maybe you don't get filled at all because price just whips through that price. So in this instance here, it would be buy stop 75.90. The limit 1% would be 76.66. So then you have to work out your risk, and this is going to be very important when we go later on in terms of the risk mitigation, because then your stop loss can vary between 2.22%, assuming you get filled here at 59.91, a penny above, but also it could be as wide as 3.18% if you got filled here on the entirety of your position at 76.66. So your stop loss on the position is going to vary somewhere between 2.22% and 3.18%, depending on where you get filled within that limit range indicated by the pink area. Hopefully that's all quite self-explanatory, and we'll do some more of those a little bit later on. So Optimise. So after 3 to 5 days, you sell 1/3 to 1/2 of your shares. Then you move your stop loss to break even, then use the 10-day moving average. Qullamaggie now uses the exponential moving average as your trailing stop. You can also use the 21-day or 20-day as well. I use the 21 EMA on my charts. Extended stocks get more extended. The whole point of swing trading is giving the stocks room to move. In day trading, you're always near your entry, always fighting near your entry. Swing trading, you've just got to let things work out. Give the stock time to trend. It's better to sell a partial a little bit too late than too early. Better to sell 10% too late than 100% too early. The only way to be in the big winners is to have some kind of trailing stop. Below is my own research analyzing 500 breakouts and recording the statistics of percentage moves before closes below the 10-day EMA and the 21-day EMA. So here you go. Here's the, and this is over these in terms of the data set, vary over many decades. So the average gain of the 500 for they closed below the 10 EMA from the breakout was 28%, and the 21 EMA was 42%. So the average RR on the 10 EMA was 5.71%, and the 21 EMA was 7.82%. Here is what it looked like in terms of the table. I can't zoom it in enough to then show you, but that is what it looked like. So for me and my own trading, I use the 10 EMA. I also use the 21 EMA, but I also hold back. If the stock, I also have in the back of my head, if the stock starts getting extended, I may choke it off by going lower the day, lower the day, lower the day, as I am going to show you in some examples. So let's get into it. On this chart here of AN, where was the optimal entry in terms of risk versus reward and efficiency of compounding capital? Then, where are the optimal entry points? So you really want to study the market from the view of studying the market. How do these stocks move? What do they do? When a stock goes up 100% or a couple 100% or 1,000%, what does it do? How does it act? Are there optimal places to get on board? Thinking about making the most amount of money possible in the shortest period of time, but also thinking about the risk that you are taking to then make that money. The best setups, the ones that make the biggest moves, are very clean in the way they act. So this is a key point here. The best setup is here, right? It's right here when you get this quote unquote trigger bar action, right? It's really tight. But you see how the move here, the black line is the 10 EMA, the blue line is the 21 EMA. They're going to be the two most important moving averages to be focusing on throughout the rest of this presentation, pretty much. So see how the stock stays above. It's not chopping around all over the place. It's not doing this. It's not just chopping around. It's just really clean. Really clean how it's just staying above. Then it starts to consolidate and pull into the rising 21 EMA as well. See how it's just consolidating into it, and then it starts getting really tight. Now the tightness is key because it can help you create a much more asymmetric risk versus reward. So here we go. This is what the setup looks like to help train your pattern recognition. See how the stock, generally speaking, starts building these higher lows, tightening from left to right. Look how the volume dries up. 52-week highs on the relative strength line. Free tool on TRADINGVIEW. Search my name, you will find it. And then you get this tightness coming through here. So let's now then plan it out, right? And let's think about the ADR percentage of this stock as well, potentially being around about 3.09%. So this is the point of trigger bars. This is how I do it. So through the high here, $6.45, that there would be the buy stop, and then the stop loss attached penny below, $6.32. Then I'd have to determine what's the limit. Invariably 0.5 to 1% through the high here, because I don't want to get filled up here at $6.60, because otherwise the risk versus reward is all out of whack. And I'm going to teach you about risk mitigation in this video as well. So the risk here, and this is the point of using these really tight bars, is 2.17%, assuming kind of perfect execution, right? Let's then play it forward. So this is the breakout here. Now what we're really now looking at is the optimizing profits as well. For okay, you've identified a nice flag, and we've got like 5 or 6 of these flag examples to go through, so you'll really start seeing flags in your sleep by the end of this video. So it starts tightening up, trigger bar, then it breaks out. So 10 EMA being the black line. So for these kind of momentum type stocks, 10 EMA, 21 EMA, but also then thinking about if the stock gets extended, lower the day, lower the day, lower the day, lower the day. I think it's a ridiculously effective selling technique to have in the bank. Lower the bar, lower the bar, lower the bar, lower the bar. Okay, so I've just given you some different percentages. So before this stock closes below the 21 EMA, over here, about 56%. Remember, the risk on the trade was just over 2%. So think about the multiples there. Then the black line here represents the 10 EMA, which is over here, about 71%. But you see here, the stock powers out, right? See how it powers out here. Now clearly it's extended. Now how will you start to train your pattern recognition to understand when a stock is extended? Look at a lot of these, okay? Train your pattern recognition, dial it in, do the work. But you see here, if you just went even from like day 4, if you just went lower the day, 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 clearly up here the stock's getting extended. 2 days prior you have this huge supply shoot on the largest volume thus far from the breakout. This is telling you that supply is coming to the market. Buyers are trying to push it up, but sellers are pushing it back down. That's an early warning sign. Then up here it's ridiculously short-term extended. So then you have to think, well, do I want to sell all of my position? Do I want to sell part of my position? That there you're going to have to think about yourself. But lower the bar, lower the bar, lower the bar will then knock you out at a 92% gain on the stock. Okay, it's a really effective sell technique. I'll show you some more. This is what it looked like on the weekly charts. You can dial your pattern recognition. The key points on these flags is understand the tightness. So tight candlesticks on average volume or above average volume, such as this bar here that's coming through, signals there is absorption of supply. Tight candlesticks like this, the candlesticks look nearly identical, but the volume is dried up, tells you there's very little supply coming through. So you're looking for absorption of supply with the tightness and the high volume, and you're looking for no supply coming through with the tightness and the low volume, okay? Here we go, Qualcomm. So on this chart here, where was the optimal entry in terms of risk versus reward and efficiency of compounding capital? Then where are the optimal exit points? So you're looking for where are the optimal entry points? Where are the optimal exit points? Here we go. This is what the setup looks like. Focus on tight setups on volatile stocks, so having the ADR there. Now the ADR would have been a little bit higher than this back there. This is at kind of present day when I print screen this. I can be asked to kind of rewind it and get the ADR, okay? But think about this ADR. Imagine it is that ADR, but it would be slightly higher, probably around about 4% or so. But see how the stock, it moves up here, and then where does it find supportive action? On the 10 EMA. Bounce off the 10, bounce off the 10. Bounce off the 10, look at the tightness, look at the volume drying up. So then we get this tight inside bar, trigger bar, and you also get this shakeout demand tail, this hammer type bar, shakeout demand tail on low relative volume. It says very much supply coming to the market. That's good before a breakout. So then the risk here, again, this ADR would have been high. But here, through the high of the trigger bar, 50.11, stop loss, penny below, 47.98. Look at the volume is half the 30 bar average. That's good. Risk, 4.27%. So then when we look at it here, okay, where are the optimal entry points? Well, if you're looking for a close below the 10 EMA, that's going to be about 39%. Still a good risk multiple trade. Below the 21 EMA, that's going to be about 37%. Still a very good risk multiple trade. But imagine if you went lower the day, lower the day, lower the day, lower the day, right? So here, this bar here, you're like, this is ridiculously extended. Look at the volume coming through. Lower the bar. Next day, oh, it's gapped up and faded. Lower the bar. Next day, lower the bar. Next day, if you went lower the bar here, you would have actually been stopped out a little bit lower because it then gapped down here. So 71%. So a combination, for me, a combination of lower the bar, lower the bar, lower the bar, and also utilizing the 10 EMA and the 21 EMA is effective. Now, I only start going lower the bar, lower the bar, lower the bar when I start thinking the stock that like this looks really extended. This looks a little bit climactic. I don't try and guess the top. As Darvis said, his stop loss was his delegate. He just let his stop loss decide. That's what I like to do. So Qualcomm, this is the weekly chart. See how it looks very similar to AN. It's a ridiculously good setup. So it's a high tight flag and then tight, 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 tight. Look how the volume dries up. Tightness and price, low volume tells you what? Tells you very much supply coming to the market. PRTS. This is in the quote by Qullamaggie. This is a 7-star setup on a 5-star scale. So see how the stock powers up here and it just respects its 10 EMA. So this is what the best of the best stocks will do. They will respect the moving average. They won't chop around all over the place like this. They'll just respect it. They'll bounce off of it. They'll find support around it. And then it starts to consolidate and the 21 starts catching up. Look at the tightness. Look how the volume dries up. Tells you there ain't much supply. And the trigger bars, the tightness, helps you create a much more asymmetric risk versus reward trade. So this is what the setup looks like the day before. Training pattern recognition skills to it. So see how it's moving up here, bounce off the 10, bounce off the 10, bounce off the 10, shake out demand tail, holds around the 10, 21 start catching up. Look at the tightness, look how the volume dries up here as well. So what does it then look like when you plan the trade out? Well, through the high, the trigger bar is 884, stop loss penny below 857. So your risk on the trade is then about 3.16%. Nice. Now, how do you go about optimizing the profits? Now, this one here, it kind of did get a little bit climactic in here. That would have knocked you out at about 57% because look, it's kind of big supply shoot, really weak close, very high volume coming through. So that could have been a lower the bar there. If you were just going with 10 EMA, it would be here, 39%, 21 EMA would be about 58% here. Clear change of character. See how it opens on the high of the bar, slices through the 10 and the 21, and the volume pops up. So it's understanding the change of character point as well. This is what it looks like on the weekly chart. Tight, tight, tight. Now the volume didn't dry up below the 30 bar average, so the 30 week average, but because of the tightness, even though you get the high volume, it's signaling that there is absorption of supply. Clear change of character. That was that for PRTS. AMD, this is a 6-star setup on a 5-star scale. Do you see where it is? Here we go. There it is. So see here, you get this gap down reversal bar as well. So I think I covered it in the Charles Harris video. Gap down reversal bars, shake out demand tails. This is a gap down reversal bar. This bar here in the middle of this flag base. So the prior close is here and just underneath $39. Then it gaps down. It opens just above. That'd be about $37.20ish, and then it pushes up here. AMD, obviously an institutional type stock in terms of who was trading it at this time as well and continues to trade it as well. So understand the games large operators are playing. So you get this shake out demand tail, shake out the weak hands, scare them out early in the session because this looks like a terrible candlestick. Then it recovers, so gap down, reversal bar, then it tightens, and then it's pretty much back-to-back inside days. The final bar, ridiculously tight inside bar, and look how the volume is just declining. Let's work out the risk. So the risk on the trade through the high of 69.3961, stop penny below 39.03 is 1.49% risk. That is exceptionally tight on a stock like this. It's ridiculously good. So AMD here, before it closes below the 21 EMA, goes up about 19%. Before it closes below the 10 EMA up here, would be on then this gap down because it then doesn't recover at about 24%. Don't know why there's a random black arrow there. There was no point here where it really kind of got climactic. Certainly up here, you see how it then starts running if you were still in this position. See how here, lower the bar, lower the bar, lower the bar, lower the bar. If you think it gets extended, lower the day, lower the day, lower the day. Effective toolbox or effective tool to have in your box, I think. Perfect breakout right here. 6-star setup on a 5-star scale. Do you see where it is? There's actually a couple of very good setups, but we're going to be looking at this one in here. So see how the stock is moving up here, and then as it pulls down, find support on the 21, 21, 21, 21. So 10 EMA, 21 EMA, really important. And then look at the change of characters coming through here. So you really want to study and optimize, okay, where's the optimal entry? Thinking about getting in and trying to compound capital very quickly and potentially getting out as well if the trade is just wrong. But then also thinking about it from a favorable asymmetric risk versus reward perspective. How can you risk $1 to try and make $5, $10, $20? And then also thinking about optimizing the sell rules as well. When is it time to just get out? So Novavax, this is what it looks like. Good move up here. Look at the volume. Stock pulls down, finds support of action on the 21, 21, 21. Then you get this ridiculously tight inside bar. Look how the volume dries up. So let's work out the risk. So the initial risk on this trade be 4.76%. Through the higher the trigger bar, stop loss, penny below. That's what you want to see. How do you then go about optimizing the profits? Well, before this stock closes below its 21 EMA, which is down here, and you already had Friday clear change of character, 170%. That's ridiculously good, especially when the initial risk is sub 5%. 10 EMA up 226%. Again, clear change of character. Look at the widespread candlestick, and it opens on the high, slices down here, volume popping up above the 30-day average. If you were to choke it off, and up here you're like, well, this is just ridiculously climactic now. So if you're then choking it off, going say lower the bar up here, you knocked out around about 260%. Is it easier in hindsight? Absolutely. But I think 10 EMA, 21 EMA, potentially thinking about lower the day, lower the day, lower the day. Think about it. That's what it looked like on the weekly chart. See, look at the volume coming through, call this bullish synchronicity. Widespread candlestick, volume confirming the move, and then just tight as it pulls back in. See how the pivot is moving sideways to down as well. Sideways to down. It's not like wedging up like this. And then see how you get this very tight inside week. Look how the volume chart is up. What does that tell you about supply? There ain't much supply coming to the market. Then works on cryptocurrencies. This is a very good setup. It went sideways for a while. It's a high tight flag. It, being price, surfs the 10 and 20 day moving averages, gets really, really tight. This is where we're going to be looking at here. Really, really tight. Okay, it's like a perfect one. From this setup, it goes up like 400-500% in a month. So this setup here, this is what we're going to be looking at. Okay. So here it is, high tight flag, shake out the martel, shake out the martel. Do you see how Bitcoin on its way up here just respected the 10 EMA whole time? See how it just respects it, and then just tight, 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 tight. Look how the volume dries up. There is no volume. There's no volume and extreme tightness in price. What does that tell you? It tells you there ain't much supply coming to the market. Nice. So then you work out the risk. Well, it'd be $47 stop loss, then $1 below or as close as you can, so $46. So you're basically targeting it through $47 with a stop at $46. Your risk on the trade is 1.93%. Nice. And then the stock runs up here. So from sub 2% risk, see how it just moves here. So if you were using the 10 and 21 EMAs and you sold on a close here, which again, hit Friday, you had like a ridiculous change of character type bar, okay? Ridiculous change of character. It would still be a 73% gain. Up here, if you were going lower the bar, lower the bar, lower the bar, which would be quite reasonable, right? Because this thing is just powering out here, 249%. So understanding if you're trading the more kind of quicker, kind of real like momentum stocks or the cryptocurrencies or the crypto related stocks, if they start getting like climactic like this, consider lower the bar, lower the bar, lower the bar. See here, lower the bar, lower the bar, lower the bar, lower the bar, lower the bar. I just think it's ridiculously effective, okay? This is ETH as well. So your job is to identify these setups. These setups have been appearing for the past couple hundred years, and they're probably going to appear for the next couple hundred years. This is how stocks and cryptos move. They move in stairs. You can clearly see one step, another step. Your job is to identify the next step when it's about to break out. You're not going to have a 100% win rate. You're going to be wrong most of the time, but once you catch a move like this, you're going to make back 50 losers in one trade, and that's how you make money. So if you look here, what does ETH do constantly before, or in the majority of cases, before it breaks out higher? Look at the tightness. 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 Then think about where is price in relation to the key moving averages. Black line, blue line, 10 EMA, 21 EMA. You could think about the purple line being the 50 SMA as well. Then think about the O'Neill point about base counts. So base 1, base 2, base 3, base 4, base 5. This one here, again, ETH. What do you notice price does before it breaks out? Invariably, tightness in price. Look at the tightness. This is kind of a VCP type base here. 1 contraction, 2 contraction, 3 contraction. Tightness. Look at the tightness here for this flag. Look at the tightness coming through. This is probably the worst of the lot because it's then kind of like wedging up. But this here is a very, very, very good setup. So this is a ridiculously good setup. So now we're into part 3, where I'm going to teach you about risk mitigation, and I'm also going to teach you about some other things as well, including pyramiding. So I think this section is going to be quite interesting. So this is going to be a little bit text heavy. It's going to involve a little bit of maths as well. So here we go. Let's say you have a stock, and let's just call it AMD, right? We all know AMD. So let's imagine this is AMD. So AMD moves up here and it sets a pivot of $100. You have 1 contraction, 2 contraction, 3 contraction. You're like, I'm going to buy it through here at $100. Okay, great. And you're going to buy 3,000 shares. So your total invested is going to be $300,000. Now your initial stop loss, you're going to put it at $95 because you see that there's this second contraction in the base. I'm going to put it at $95. Side note, I would go a couple pennies below a round number, but for illustration purposes, let's just say $95 because the maths is nice and easy. That's going to be a 5% stop loss. So your total risk on the trade is not 300 grand. Well, it might be if it goes to 0 the next day, but your total risk on the trade more reasonably is 15,000. Okay, because you have $5 risk per share, 3,000 shares, 3 times 5, right? Get it. Okay. Then your new stop loss. So now you imagine this is then going into free rolling and risk mitigation. Don't worry, a couple more slides on this. It'll make sense. You've probably never seen anything like this before. So here it powers out the stock. AMD powers out and it goes to 106. So now it's at 106 and you're like, well, this is quite good. I have a 6% gain on the stock. Yes, but your open risk is still 5%. Okay, your open risk is still 5%. So what you decide to do is you go, I could bump up my stop loss because now I see there's this other contraction, and maybe say the 21 EMA is caught up, or maybe the 50 SMA is caught up, or maybe the 10, or whatever it may be. But for whatever reason, you go, let me start mitigating risk. So there's 4 parts to every trade: identify, control, mitigate, optimize. We're really focusing on the third part, which is risk mitigation. So here you go, I'm going to reduce some of the risk. I'm going to mitigate some of the risk. I'm going to move my stop loss from $95 to $97. So we've gone from a 5% stop to a 3% stop. But now we've got an opportunity to do something here. So our new total risk on the trade is 9 grand. So we've gone down from 15 grand to 9 grand because we have 3,000 shares. Now we have $3 risk per share instead of $5. But then what we do is we go, well, now I'm up 2 times. So the free roll levels is half your position at 1 times your stop loss. That could be initial stop loss or new stop loss. It could be 1/3 at 2 times your initial stop loss or new stop loss, or it could be a quarter at 3 times your initial stop loss or your new stop loss. So now you go, well, I could sell 1/3 of my position, which is 1,000 shares at $106. So remember, you've got $6 profit and you've got a $3 stop loss now. So 6%. So what you could do by selling those 1,000 shares is lock in $6 profit, because you've got 1,000 shares with $6 profit. So 1,000 times 6, 6,000. You following along? So your total risk left is now $6,000. Why? Because you've got 2,000 shares with a $3 stop loss. Because remember, you bought them at 100 and your stop is $97. So that's your $3 stop loss, and you have got 2,000 shares. So your open risk on those is 6 grand. But hang on a minute. Remember that you just banked 6 grand profit by selling 1/3 1,000 shares up here at 106. So you now have your $6,000 profit minus your $6,000 risk left. $0 risk. Hypothetically, you can have gap downs, you can have slippage and stuff like that. Now you have free rolled the trade. Make sense? Nice. And you still have 2/3 of your position. And then we're going to talk about pyramiding a little bit later on. So this here is an effective strategy. Why I use buy stop limit orders and then stop losses, and then you sell limit orders to sell part of the position at risk multiples of the initial stop loss or potentially the new stop loss. Because I'm trying to free roll the position. Sun Tzu, Art of War quote. I want to position myself beyond the possibility of defeat as soon as prudently possible. Show you an example. So here, this is AXM. Now I know you're like, what's going on here? Don't worry, we'll walk through it. So I showed you this chart a little bit earlier on. So let's now walk through it. So what we're going to say is we're basically going to buy it in this region here using the buy stop limit order. We're then going to sell part of the position to free roll the trade within the first, and this is a 1 hour chart, so within the first hour. Okay, so imagine we buy 3,000 shares and we get filled at $76.66. So our total cost is $229,980. So basically 230k. Okay, so we used the buy stop limit order, and our buy stop was for 3,000 shares. And we said, okay, if price moves through here, that's when we want our order to get triggered. So that's the buy stop, 75.90. Now we're going to attach a 1% limit to the trade. So we don't want to pay any more than $76.66. Great. Now we can figure out the maximum risk we're going to have on this trade, because we know the maximum amount we're going to pay for any shares. So we then get filled up here. That's what I'm saying. 3,000 shares filled at 76.66. So our risk on the trade now is 3.18%, because our stop loss is down here on the 3,000 underneath the low of that trigger bar at 74.22. Okay, great. Now we know our free roll target as well, because it can be 2 times our stop loss or potentially our new stop loss. So let's work it out. So our stop loss is at 74.22. Down here, that's 3.18% risk. Okay, here, this pink line is showing you that. So your total risk on the trade is $7,320. Why? Because we have $2.44 risk per share times our 3,000 shares. Nice, easy maths, okay? Then we sell 1,000 shares, so 1/3 of the position at 81.57. Why do we do that? Because that's 2 times our stop loss. So if you think about it, our stop is 3.18%. So if we sell 1/3 at 2 times our initial stop, this works when it is single digit percentages. Remember that losses work geometrically against you. So if your initial stop is like 15, 20, 25%, it's not going to work like this, okay? Losses work geometrically against you. So 2 times 3.18% is roughly 6.4%. I couldn't get it perfectly to 6.36% using the percentage thing here. Is irritating. But 6.4% is 2 times our initial stop of 3.18%. Make sense? So now we sell 1,000 shares, 1/3 of the position at 81.57, 2 times the stop loss. So we lock in by selling here at 81.57. We lock in $4,910 profit. Cool. Now our remaining risk of 2,000 shares times by $2.44 risk, $2.44 risk per share equals $4,880. Now what do you notice? Our risk is now less than the profit that we just booked. So we've got 2,000 shares left that we bought here at 76.66, and the stop on those 2,000 is still down here at 74.22. So our open risk on those is 4,880. But remember, we just sold 1/3 of the position up here at 81.57 and locked in $4,910 profit. Nice. So now we have our profit of 4,900 minus the remaining risk of 4,800 means we have about $30 profit. We have free rolled the position. Hypothetically, of course, you can get gap downs, you can get slippages and stuff like this. That's starting to make sense. Quite cool. Now let's go into the pyramiding side of things. So now you can see why I like buy stop limit orders through these nice tight trigger bars. So pyramiding, increasing exposure whilst minimizing risk. So phase one was like we were talking about, and we were saying it's hypothetical AMD. Okay, so we're buying 3,000 shares at $100, but we're just going to forget about the $95 stop loss. We're just going to say our stop loss is at $97. We sell the 1,000 shares again, like we did in that example that we were calling AMD, at 106. So we free rolled the trade, right? Let me just walk you through phase one, because that's all happening in here. So the pivot is 100. We buy 3,000 shares at the pivot here. Our total invested 300 grand. Our initial stop loss is $97, 3%. But again, I'd be a couple pennies below that because I like my stops below round numbers. Total risk on the trade is 9 grand. Why? Because we have 3,000 shares times by $3. Again, that assumes that there's not going to be a big gap down on earnings, all of that. It's just hypothetical example. Stay with me. Then we're going to sell 1/3 of the position, 1,000 shares at 106, which is 6%, which is 2 times the initial stop loss. Okay, so 3%, 3 times 2 is 6. $3 times 2 is $6. Makes sense? That's why we're selling at 106 up here. So we're locking in 6 grand profit. Why? Because we're selling 1/3 of the position, so 1,000 shares at $6. So our total risk left is the $6,000. Because we have got 2,000 shares with a $3 stop loss. However, we have $6,000 profit that we just banked minus our $6,000 risk left. So we have $0. Hypothetically, we free rolled it. Great. But now let's go into the pyramiding side of things. So phase two, you see that, and this is applicable for potentially, so Mitivini language, if you're looking at, say, a low cheat or a cheat, and then you see that a higher pivot form. So you enter on, say, the low cheat or the cheat, and then a higher pivot form. So potentially have an opportunity to add. So I've showed this as kind of like a base and then a subsequent base setting up, but it could be kind of a lower pivot and then a higher pivot setting up. So it could be a cup and handle forms, and you enter it around, say, the low of the cup, and then you're re-entering or adding to the position on the handle. Hopefully that there makes sense. Or it could just build, say, another base, another kind of flag type pattern here. So phase two. Remember, we already have $6,000 profit locked in from our phase one operations. So what are we going to do? Well, here we say, well, hang on a minute. It's starting to set another pivot. We have this base. We have 1 contraction, 2 contraction, 3 contraction. We'll just call this magical blue line the 21 EMA. And then it's setting another pivot around 106. Interesting. So here we go. We could move our stop loss on the 2/3 that we have left, which is 2,000 shares to $103. So we're moving the 2,000 shares, which is 2/3 of the position we had. We're moving it from $97 up here to $103. I'll explain that in a minute. So we're backstopping in 6 grand profit. Why? Because we have 2,000 shares times $3 profit per share. Makes sense? Because the profit on those shares, we're backstopping it in by now moving our stop loss. We bought them at 100, we're adjusting our stop loss to 103. So 3 times 2,000 shares is 6 grand. Hopefully you're following along. Then what we're going to do is we're going to add 2,000 shares through this new pivot at 106, and our stop loss is going to be here at 103. So the new risk, we have $6,000 new risk on the new shares. So 2,000 shares that we're adding through here, and they have $3 risk per share. So the 2,000 times 3 means that we're going to have $6,000 risk on the new 2,000 shares, but on the 2,000 shares we have from the original position, we're backstopping in 6 grand profit. So our 6 grand profit backstopped minus our $6,000 risk on the new shares equals break even free rolled, but doubled the position size to 4,000 shares. So we've now been able to double our position size up and increase from the original position size of 3,000 shares. But at the minute, we've now doubled our position size from 2,000 shares to 4,000 shares, and we have no risk, but we've doubled our position size. That's really nice. Such is the nature of pyramiding. Now, as I said, the way I've showed this is kind of a flag, a breakout, another flag, but it could be kind of, it's a cup and handle building, and it's kind of a low pivot in a cup, and then a higher pivot in the handle or something like that. So then you're adjusting the stop loss up, working out the math, so on and so forth, right? Let me show you an example on Amazon. Stay with me. I appreciate when you first look at it, you're like, what's going on? So we'll work it through phase 1 and phase 2. So phase 1 is going to be this base that you see in here. It's a bit more of kind of a Davis box type base, I would say. So let's say we're going to enter here. So this is entry for phase 1. So we're going to buy 3,000 shares at $3.19. So our total cost is $9,570. We're going to put a stop loss at $3. Now I would actually go 299, 298, 297, so I'm a penny below, right? And still make sure the risk makes sense. So our stop is going to be at $3, which in this instance here is 6.03%. So our total risk is $570. Why? Because we have 19 cents risk per share times the 3,000 shares that we just bought. So what we could now do is sell 1,000 shares, 1/3 of the position at $3.58. Why? Because that's 2 times our stop loss, so about a 12% gain up here. Okay, selling it in this vicinity here. That's going to be $390. Now we have remaining risk of the 2,000 shares times the 19 cents risk per share equals $380. That's it, you're following along. Profit of $390 minus the remaining risk of $380 equals $10 profit. So the position is free rolled. Why? Because we entered here, we bought 3,000 shares here, initial stop loss down here at $3. We then sold 1,000 shares, being 1/3 of the position at 2 times the initial stop. So the initial stop was 6%, so we then sold 1/3 of the position at 12% in here, which we said was around about $3.58. Therefore we free rolled it and we've maintained our stop loss down here. Nice. But now we go into phase 2. So Amazon starts tightening back up here and you're like, there's a new pivot, I could buy it through the high of this bar. Now I know there's a little gap, so you wouldn't have actually been filled at $3.53, but just for the purpose of this, imagine that it is, okay? So here you're like, it's building another pivot. I want to add to my position. Okay, so remember, we've got 2,000 shares left from our phase 1 operations. So we could move our stop loss on the 2/3 to $3.37 from $3. So we're moving it from here, $3 up to here, this pink line now, $3.37. So we're backstopping in a profit. So we've now backstopped $360 profit, okay? 2,000 shares times 18 cents per share, because we are then selling here because we've moved our stop loss up from 319 to 337, 18 cents times the 2,000, that's how we get to the 360. So now what we could do is we could add 2,000 shares at the new $3.50 pivot with the stop loss at $3.37. So we're looking to add 2,000 shares here, so double our current position size and put the stop loss on the new shares here, where we are doing it with the remaining 2,000 shares that we already had at 337, okay, with the stop loss at 337. So we have got $320 risk on the new shares. Why? Because we're buying 2,000 shares with 16 cents risk per share. So that's $3.53 minus $3.37, 16 cents risk per share. So the $360 backstop profit minus the $320 risk on new shares equals better than break even on the new position, but doubled the position size to 4,000 shares plus $40. So plus we have booked profit of $390 from the phase 1 operations, because remember, we sold 1,000 shares at a profit of 12% up here. So we have our $390 profit over here. We have our $390 profit that we've already locked in from the 1,000 shares that we sold higher. So plus book profit of $390 from phase 1 of the trade means worst case scenario of getting stopped at 337. Of course, there can be gap downs on earnings slippage and stuff like that. At $3.37 equals $430 profit. Why? Because we have our $390 plus our $320 of backstop profit on the remaining 2,000 shares up here, minus the cost if we get stopped out of our new shares, buying them at $3.53 and our stop loss at $3.37. That there, you may have to watch that a couple of times for it to sink in. So I will wrap the video up there, guys. I hope you have really enjoyed it. You have learned something from that video. If you could please like the video, subscribe to the channel if you haven't done so already to be notified of when I release more videos like this. That would be fantastic. If you have any questions, please do leave them in the comment section down below. I will do my best to personally